FTX is a Ponzi scheme. Collapsed. Game over. Hello viewers, welcome to my YouTube channel. Today in this video we will talk about FTX, that is a Ponzi scheme. It looks like FTX is turning out to be the biggest Ponzi scheme scam ever. This company promised to revolutionize the way we trade crypto, but it turns out they were just looking to make a quick buck. Now, people who have invested in FTX are being left high and dry, with no way to get their money back. If you've been scammed by FTX, or if you're thinking about investing in them, watch this video till the end. We'll tell you everything you need to know about this scheme, and how to avoid getting scammed yourself. What is FTX? FTX is a Ponzi scheme that has been masquerading as a legitimate investment opportunity. It promises high returns with little to no risk, but the reality is that it is nothing more than a scam. Investors who have put money into FTX are now facing huge losses, and the company behind the scheme is nowhere to be found. FTX has filed for bankruptcy protection in the US after it was unable to meet a torrent of withdrawals, marking a stunning collapse for Sam Bankman-Fried's crypto empire that was valued at $32 billion just months ago. The filing in a federal court in Delaware on Friday includes FTX's US entity, Bankman-Fried's proprietary trading group Alameda Research, and about 130 affiliated companies. What is a Ponzi scheme? A Ponzi scheme is an investment scam that promises high returns, but instead uses money from new investors to pay older investors. Ponzi schemes are named after Charles Ponzi, who became famous for using the scheme in the early 1920s. Ponzi schemes are often disguised as legitimate investments. For example, in a Ponzi scheme involving a fake investment company, victims might be promised that their investments will be used to buy and develop land or to fund other projects that will generate high returns. However, instead of using the money to buy land or invest in legitimate projects, the operators of the scam simply use it to pay earlier investors, giving the appearance of profitable returns. Operators of Ponzi schemes can also use funds from new investors to pay themselves rather than investing it in a legitimate business venture. As long as there are enough new investors willing to put their money into the scheme, it can continue to operate and even grow. But eventually, there are not enough new investors and the scheme collapses, leaving many people out of pocket. Ponzi schemes are illegal in many countries because they involve fraud and deception. If you think you may have been scammed by a Ponzi scheme, you should report it to your local authorities or financial regulator. A Ponzi scheme, for those in need of a refresher, is an age-old fraud in which inflows of new money pay off earlier investors. But the story ends the same way: champagne for those at the top, tears for everyone else. US investigators have busted a handful of crypto Ponzis over the years. Among them is OneCoin, which was based in Bulgaria and which prosecutors allege brought in roughly $4 billion from investors around the world. How did people get scammed by FTX? There are a number of ways that people have been scammed by FTX. The most common way is through the use of Ponzi points. Ponzi points are a way for FTX to artificially inflate their prices and lure in new customers. They work by allowing customers to buy a currency at an inflated price, and then earn a commission on every sale made using that currency. The problem is that, because the prices are inflated, there is no way for customers to actually make any money from using the currency. In fact, they will end up losing money as the price eventually crashes back down to its real value. Another way people have been scammed is through the use of bait and switch tactics. This is where FTX will advertise one thing, but then deliver something completely different. For example, they may advertise an investment opportunity that promises high returns, but then switch the terms and conditions so that the customer actually ends up losing money. Finally, another common scam tactic used by FTX is called phishing. This is where they will send out fake emails or messages purporting to be from a legitimate company or website in order to trick people into giving away their personal information or money. What can you do if you've been scammed by FTX? If you've been scammed by FTX, there are a few things you can do. First, if you have lost money as a result of the scam, you should report it to the Federal Trade Commission. You can also file a complaint with the Consumer Financial Protection Bureau. In addition, you can contact your state attorney general's office and file a complaint. You should also consider contacting an attorney to discuss your legal options, and whether you may be able to recover your losses through a class action lawsuit. What are the red flags of a Ponzi scheme? A Ponzi scheme is an illegal investment scam where money from new investors is used to pay off older investors. The scheme relies on a constant stream of new investments to keep it going, and eventually collapses when there are not enough new investors. There are several red flags that can indicate a Ponzi scheme. Number 1. Promises of high returns with little or no risk. Any investment that promises high returns with little or no risk is likely too good to be true. If it sounds too good to be true, it probably is. Number 2. Pressure to invest quickly. Ponzi schemes often rely on pressure tactics to get people to invest before they have a chance to think about it or do their research. Number 3. Unregistered investments. Most legitimate investments are registered with the Securities and Exchange Commission, SEC. If an investment is not registered, that should be a red flag. Number 4. Complex structure. Ponzi schemes often have complex structures and use convoluted language to make them sound more sophisticated than they really are. If you don't understand how the investment works, be wary. Number 5. No verifiable records. A legitimate investment should have clear records of where the money is coming from and where it's going. If there are no records or the records are vague, that's a warning sign. Number 6. Insider trading. Ponzi schemes often involve insider trading, which is illegal. If you're being told to buy or sell a security based on non-public information, that's a red flag. Number 7. Lack of transparency. A legitimate investment should be transparent about its operations, finances, and investment strategy. If you can't get clear answers to your questions, be wary. Number 8. Promises of guaranteed returns. There's no such thing as a guaranteed return on an investment. Anytime someone tells you that you're guaranteed to make money, it's a huge red flag. How to avoid getting scammed by a Ponzi scheme. Ponzi schemes are all about taking money from new investors to pay off older investors, and they always eventually collapse. If you're thinking about investing in a Ponzi scheme, there are a few things you can do to try to avoid getting scammed. Do your research. Make sure you understand what the investment is and how it works before you put any money into it. Be wary of promises of high returns with little or no risk. Any investment that sounds too good to be true probably is. Ask questions and get answers in writing. If the person trying to get you to invest seems evasive or unwilling to answer your questions, that's a red flag. Get everything in writing, including any promises made about the investment. This will help protect you if the investment turns out to be a scam. If you follow these tips, you'll be less likely to fall victim to a Ponzi scheme. So this was our today's video. I hope you all liked this video. Don't forget to hit the like button and subscribe my channel, and also share it with your friends and family. We will be back soon with a new video. Till then, keep supporting and take care.